Hello and welcome to this week's edition of FMR Finance Weekly, specially created for our esteemed NRI viewers. Your appreciation and positive feedback have been incredibly heartening. We are overwhelmed by the numerous queries we receive from our fellow NRIs on a daily basis. We are truly humbled and honored to provide assistance in a wide range of financial matters to our fellow NRIs. One of the most common questions we encounter is from NRIs looking to set up a business in India, whether they are planning to expand their existing overseas business or establish a new venture in India. There are three common dilemmas that many NRIs face. First, what is the most appropriate structure that will suit their business operations in India? Second, what are the requisite registrations required for carrying on business activities in India? Third, how to ensure regular compliances are maintained and there are no deficiencies in the same. We are excited to share that we'll be addressing these three key questions in an upcoming three-part series titled Navigating Business Setup in India, a Guide for NRIs. I am Chetan Nagar, your tax advisor, making finance friendly.
FMR Finance Weekly. Simplify your life with our financial advice.
In today's segment, we shall address the very fundamental question: what are the various entity structures that are available in India? You might have heard terms like proprietorship firm, partnership firm, limited liability partnership firm, private limited company, Section 8 company, etc. Don't worry if you haven't heard these terms or are unaware of what they actually mean. Let me help by discussing about each of these entity structures and also their appropriateness for respective business operations. First up is sole proprietorship. A sole proprietorship is one of the oldest and easiest business structures to start in India. It is a business owned, managed and controlled by a single individual who is known as the proprietor. Few key considerations related to sole proprietorships in India are: first, ownership and liability. The proprietor and the business is considered the same entity. The proprietor is personally responsible for all the assets, liabilities, and obligations of the business. Second, partnership or shareholders. A sole proprietorship cannot have partners or shareholders. It is solely owned and operated by one individual. Third, minimal compliance. Compared to other business structures, sole proprietorships have minimal compliance requirements. Fourth, proprietor's identity. To carry forward the business, the proprietor needs to open a separate bank account for the business and register for goods and service tax using their own PAN card number and Aadhaar number. Fifth, legal entity status. In India, a sole proprietorship does not have a separate legal entity status. The proprietor and the business are considered one and the same entity for all legal and official purposes. So it's important to note that while a sole proprietorship offers simplicity and control, it also exposes the proprietor to personal liability and limits the growth potential of the business. Additionally, sole proprietorships may face challenges in accessing external funding and lack the continuity that comes with having a separate legal entity. Consulting with our finance experts to understand the specific requirements and implications of starting and operating a sole proprietorship in India is highly recommended. Next up is partnership firm. A partnership firm is a form of business organization where two or more individuals come together with a common goal of carrying out a profitable business venture. The partnership firm is governed by the Indian Partnership Act of 1932, which outlines the rights, duties, and liabilities of the partners involved. In a partnership firm, the partners contribute capital, share profits and losses, and jointly manage the operations of the business. Some of the key features of a partnership firm are: first, partnership agreement. The agreement defines the terms and conditions governing the partnership, including capital contributions, profit sharing ratios, decision making authority, and the duration of the partnership. Number 2, number of partners. A partnership firm must have a minimum of 2 partners. However, there is generally an upper limit on the number of partners, which depends on the type of partnership and local laws. Third, mutual agency. One of the fundamental principles of the partnership firm is the concept of mutual agency. Each partner is an agent of the firm and has the authority to bind the partnership and make decisions on its behalf. This means that the actions of one partner can have legal consequences for the entire firm. Fourth, unlimited liability. In a partnership firm, partners have unlimited personal liability for the debts and obligations of the business. This means that if the partnership firm cannot meet its liabilities, partners' personal assets can be used to settle the debts. Fifth, profit sharing. The sharing of profits and losses is typically determined by the partnership agreement. Sixth, dissolution. A partnership firm may dissolve in various circumstances, such as the expiration of the partnership term, the death or insolvency of a partner, mutual agreement, or court order. We highly recommend to seek advice from our finance experts who can assist in creating a thorough partnership agreement, incorporating all pertinent aspects to facilitate a compliant and seamless operation of your partnership firm in India. They will provide guidance on the various types of partners and highlight the significant distinctions between partnership, company, LLP, and proprietorship business structures. Next up, third entity structure is limited liability partnership or LLP. A limited liability partnership or LLP is a unique business structure that combines the benefits of the partnership and the limited liability protection of a company. It was introduced in India in 2008 under the Limited Liability Partnership Act, offering a flexible and scalable options for small and medium-sized businesses. Some key features of LLP are: first, separate legal entity. An LLP is considered a separate legal entity from its partners. It has its own existence distinct from its partners, allowing it to own assets, enter into contracts, and sue or be sued in its name. Second, limited liability. One of the key advantages of an LLP is limited liability protection. Unlike in a traditional partnership where partners have unlimited liability, the liability of partners in an LLP is limited to their agreed contribution to the LLP. Partners are not personally liable for the debts or liabilities of the LLP. Third, flexible management. LLPs offer flexibility in terms of management structure. Partners have the freedom to decide how the LLP will be managed and the roles and responsibilities of each partner. Fourth, minimum number of partners. To form an LLP, a minimum of 2 partners are required. However, there is no maximum limit on the number of partners, providing an opportunity of scalability and growth. Fifth, LLP agreement. LLPs are governed by an LLP agreement which outlines the rights, duties, and obligations of the partners. Sixth, perpetual succession. LLPs enjoy perpetual succession, meaning that the LLPs continues to exist even if one or more partners leave or new partners are added. The LLP's existence is not affected by the changes in its partners' composition. LLPs present an appealing business structure for small and medium-sized enterprises in India, combining the benefits of limited liability protection and management flexibility. Their hybrid nature and streamlined compliance procedures make LLPs a viable choice for entrepreneurs aiming to strike a balance between safeguarding personal liability and achieving operational adaptability. Fourth entity structure, which is very popular in India, is private limited company. A private limited company provides a separate legal entity status to the business and limited liability protection to its shareholders. Governed by the Companies Act 2013, a private limited company offers several advantages and is commonly chosen by the entrepreneurs and businesses looking for growth and credibility. Key features are: first, separate legal entity. A private limited company is considered a distinct legal separate entity from its shareholders. It can own assets, enter into contracts, and sue or be sued in its own name. Second, limited liability protection. Shareholders of a private limited company have limited liability, meaning their personal assets are generally protected from the company's debts and obligations. Third, minimum shareholders. A private limited company must have a minimum of 2 shareholders. Fourth, share capital. Private limited companies issue shares to its shareholders, which represent their ownership in the company. The company can raise capital by issuing shares to investors, family members, or employees. Fifth, Board of Directors. A private limited company is required to have a board of directors consisting of at least two directors. These directors are responsible for managing the company's affairs, making key decisions, and ensuring compliance with statutory requirements. Sixth, annual compliance. Private limited companies have certain annual compliance obligations, including filing annual financial statements, holding AGM meetings, and maintaining proper accounting records. Now, on to the last but not the least is the Section 8 company. A Section 8 company, as defined under Companies Act 2013, is a type of non-profit organization that is formed for promoting charitable, educational, scientific, religious, or any other social cause. The primary objective of a Section 8 company is to apply its profits or income towards promoting the objectives and not to distribute dividends to its members. Few key features and characteristics of Section 8 company are: first, non-profit nature. A Section 8 company is formed with the sole purpose of promoting charitable or social objectives. It must utilize its incomes, profits, or any other earnings for furthering its objectives and not for benefit of its members. Second, limited liability. Like other types of companies, Section 8 company enjoys the benefit of limited liability. Third, no dividend distribution. Unlike other types of companies, a Section 8 company is prohibited from distributing any dividend or profits to its members. The surplus generated from its operation is to be reinvested for furthering the objectives. Fourth, licensing requirements. To establish a Section 8 company, an application must be made to the Registrar of Companies for obtaining a license. The ROC evaluates the proposed activities and objectives of the company to ensure they are in line with the requirements of a Section 8 company. Fifth, name restrictions. The name of a Section 8 company must reflect its non-profit nature and should not resemble or be similar to any existing company or trademark. Certain words such as foundation, association, society, or council are commonly used in the names of Section 8 companies. In conclusion, a Section 8 company provides a structured and legally recognized form for organization with non-profit objectives. It allows them to focus on social causes while enjoying the benefits of limited liability and tax exemptions. I hope you got more clarity on how to set up business in India. For more personalized assistance or further clarifications, do reach out to us. In the next segment, we shall address what are the requisite registrations that are required by business entities to operate in India. So until then, you do not miss out on the exciting stuff. Hit the notification button now and don't forget to like, share and subscribe to our YouTube channel File My Return. I am Chaitanya Garg, your tax advisor, making finance friendly.
FMR Finance Weekly. Simplify your life with our financial advice.